All right, let's talk about life insurance. It's one of those huge financial decisions you have to make, but honestly, it's also one of the most confusing. So we're going to cut through all that noise. In this explainer, we are going to build a simple, super clear plan to make sure your family is protected the right way.
Okay, I'm going to start with a question that's, well, it's a little uncomfortable, but it's probably the most important one we'll ask today. Just think about it for a second. If you didn't wake up tomorrow, would your family really be okay financially? Like, could they keep the house, pay all the bills? And look, I'm not talking about emotionally, of course. Not. I'm talking about the cold, hard financial reality.
And here's the really scary part. Most people genuinely think they're protected. They bought a policy, they feel good. But the truth? Millions of families who have life insurance are still totally exposed to a financial disaster. That's what we're going to fix today.
All right, let's get into it. The only way to get through all this confusion is to go right back to the basics. So let's start with the real purpose of insurance. Because, this is where everything starts to get messy. The industry is just packed with confusing jargon and a ton of sales pressure, and it feels like it's all designed to distract you from one simple truth.
So let's just simplify this right now. Forget all the hype you've heard about investments or beating the stock market with your policy. The real job of life insurance is incredibly simple. It has one job and one job only: to make sure your family doesn't become poor if you're gone. That's it. Full stop. It's a safety net, plain and simple. It is not a lottery ticket. And once you really let that sink in, every other decision gets so much easier. Okay, so let's look at how misunderstanding that one single point leads to the most common and, by far, the most expensive mistake people make. Seriously, the financial consequences here are just staggering. When you really boil it all down, there are basically two main choices. On one side, you've got term life. The best way to think about this is like you're renting protection for a specific amount of time, say 20 or 30 years, when the kids are young and the mortgage is huge. It's simple, it's affordable. Then on the other side, you've got permanent life. Now, this stuff is designed to last forever, and it does that by mixing your insurance with a really complex, high-fee investment account. It is way, way more expensive, and honestly, this is where most of the bad decisions are made. So let's see how this actually plays out for a real person. Let's meet John. He's 35 years old, has 2 kids, and he absolutely wants to do the right thing for his family. So an agent comes along and sells him on one of those permanent policies. The ones they last forever and they're supposed to build cash value? Okay, so for $500,000 of coverage, John's permanent policy cost him an incredible $650 every single month. But for the exact same $500,000 of protection, a simple 20-year term policy would have been, around $35? The difference is it's mind-boggling. I mean, do the math. Over 2 decades, that's a difference of more than $147,000. That right there is the true cost of unnecessary complexity. We're not talking about a small rounding error here. That is a life-changing amount of money. Just think about that for a second. That is money that could have been invested, saved for college, used to build actual, real wealth for his family. And here's the kicker. John wasn't being irresponsible. He was trying to do the right thing. He was just sold a really complicated product he didn't need. And let's be honest, it's often because that product came with a much, much bigger commission for the salesperson. So the big question is, how do you avoid making John's mistake? Well, the good news is it all comes down to a really simple framework, one that puts you in control, not a salesperson. Okay, the most important thing here is to completely forget that generic advice, like just buy 10 times your salary. That's useless. We need to find your real number. So here's how you do it. First, figure out the income your family would need to replace every year to live comfortably. Second, add up all your debts. I'm talking the whole mortgage, car loans, student loans, everything. Third, think ahead to those future big expenses like college tuition. And finally, just subtract what you already have in savings and investments. That gap, that's your target. And look, when you actually run those numbers, you get a real, specific, personalized goal. So in this example, it's about $1.8 million. See the difference there? This isn't some random guess from an article you read. It's a number that is tailored precisely to protect your family's actual lifestyle. But here's the thing, getting the dollar amount right is only half the battle. You also have to make sure that protection lasts long enough. And believe me, getting the timing wrong can be an absolute disaster. Let me give you a quick example.
Let's talk about Maria. She bought a cheap 10-year policy, and, she felt great about it. Problem solved. But then 10 years go by. Suddenly, her kids are still financially dependent, the mortgage is definitely not gone, and poof, her policy just expires. Now she's older, maybe she has a new health issue, and trying to get a new policy is going to be drastically more expensive. A real nightmare.
So, how do you avoid that? How do you keep from making Maria's mistake? How long should your term actually be? Well, the answer is actually pretty simple. Your policy needs to match your period of financial dependency. All you have to do is ask yourself two questions. When will my youngest kid be independent? And when will my mortgage finally be paid off? For most families out there, a 20-year term is the absolute bare minimum. But you know what? A 30-year term is often the smartest and safest choice you can make. All right, we've covered a lot. So now let's take everything we've talked about and boil it down into a simple action plan. A checklist, really, to make sure you get this right. Okay, first things first, let's lock in what to avoid. These are the 5 biggest mistakes we see people make over and over and over again. Number 1, buying way too little coverage. 2, overpaying for one of those complex permanent policies. 3, choosing a term that is just way too short. 4, confusing insurance with an investment. They are not the same thing. And finally, number 5, just setting it and forgetting it and never reviewing your coverage. So here it is. This is your 5-step smart protection checklist. Let's run through it. 1, calculate your family's real financial need, not some generic number. 2, for almost everybody, simple term insurance is the way to go. 3, pick a term, 20 or 30 years, that gets your kids out on their own and gets that mortgage paid off. 4, always, and I mean always, compare quotes from different companies. It's a must. And 5, put a reminder in your calendar to review your coverage anytime there's a major life change, like a new baby or a new house. So, I'm going to leave you with one final thought to really chew on. Whether you already have a policy or you're just starting to think about getting one, you need to ask yourself this one simple, powerful question. Does this policy truly protect my family from a financial disaster, or does it just make me feel protected? I promise you, answering that question honestly, well, it makes all the difference in the world.